Hey, it's DPerry, and I am a realtor with Property Consultants in Bucktown. And today on Logan Square and West Townhomes Live, I'm going to share with you a free report entitled Tax Deductions for Homeowners, How the New Tax Law Affects Mortgage Interest. Now, there's two things which are certain: death and taxes. And you know what? Neither of them sound like a lot of fun, especially taxes. Boring. I get it. Okay, but you know what? It's that time of year where you're starting to compile, all of your receipts and your information and everything. And A, you're either going to plug it into TurboTax, or B, you're going to go to a preparation firm, or C, you're going to hand it all over to a CPA. So it's important that you understand, how the new tax laws affect you as a homeowner. So we're going to get right into it. This report is brought to you by House Logic, which is made possible by realtors. Before we get into it, though, I want to offer you a freebie. It's called Market Snapshot. It is what its name implies. Market Snapshot gives you a snapshot of real estate activity around any area in Chicagoland that you choose. So how does it work? You get an email, you click the link, bam, here you are. This is the home page. It's a summary page. You can drill down into the summary information here for an explanation as to how things are calculated. You can click the bullseye on the screen, and bam, there you go. The market snapshot. So you've got color-coded houses which correspond to these large buttons, and the buttons represent the different status. You can filter what you see on the map by clicking the buttons on and off, and you can sort what you see in a variety of different ways. Most recent activity, closest to target location, highest to low. You get the idea. And if you drill down into one of the houses, it's highlighted on the right, and you get to see, all the pictures that come with it, as well as property details such as room dimensions, flooring, etc. If you have school-age children, you get information on the schools nearby, and you get neighborhood information because, after all, your home is more than just the four walls that you reside within. It also includes the shops, the restaurants, the parks, the organizations. So you can drill down and you can see reviews on Yelp, as well as pictures and menus and the hours and the whole nine yards. So it's a wonderful tool. Guess what? The price is absolutely right. It's free. If you're interested in it, all you have to do is click the link that's in the show notes. All right, so now back to the report. Okay, tax deductions for homeowners, how the new tax law affects mortgage interest. Tax changes for 2019 changed the landscape for homeowners. Tax season is upon us once again. And to make it even more interesting this year, the tax code has changed, along with the rules about tax deductions for homeowners. The biggest change: many homeowners who used to write off their property taxes and the interest they pay their mortgage will no longer be able to. Now stay calm. This doesn't automatically mean your taxes are going up. Here's a roundup of the rules that will affect homeowners and how big of a change to expect. Standard deduction. There's a big change. The standard deduction, that amount everyone gets, whether they have actual deductions or not, nearly doubled under the new law. It's now 24,000 for married joint filing couples. It's up from 13,000. It's 18,000 for heads of household, up from 9,550, and 12,000 for singles, up from 6,500. Many more people will now get a better deal taking the standard than they would with their itemizable write-offs. For perspective, the number of homeowners who will be able to deduct their mortgage interest under the new rules will fall from around 32 million to about 14 million, the federal government says. And that's about a 56% drop. Now, this doesn't necessarily mean they'll pay more taxes, says Evan Ledyard, a CPA and director of federal tax policy for the National Association of Realtors in Washington. It just means that they'll no longer get a tax deduction for buying or owning a home. So, will you be able to itemize, or will you be in standard deduction land? There's a calculator in the full article which will help you to estimate that. And if the answer is standard deduction, you'll be pleased to know that tax forms are easier when you don't have to itemize, says Lydiard. All right, mortgage interest deduction, incremental change. The new law caps the mortgage interest you can write off at loan amounts of no more than $750,000. However, if your loan was in place by December 14, 2017, the loan is grandfathered and the old $1 million maximum amount still applies. Since most people don't have a mortgage larger than $750,000, they won't be affected by the cap. But if you live in a pricey place like San Francisco, where the median housing price is well over $1 million, or you just have a seriously expensive pad, the new federal tax law means you're not going to be able to write off interest paid on debt over the $750,000 cap. State and local deduction. Degree of change varies by location. The state and local taxes you pay, like income, sales, and property taxes, are still itemizable write off. That's called the SALT deduction in CPA lingo. But the tax changes for 2019, that's tax year 2018, mean you can't deduct more than $10,000 for all your state and local taxes combined, whether you're single or married. It's $5,000 per person if you're married but filing separately. The SALT cap is bad news for people in areas with high taxes. The majority of homeowners in around 20 states have been writing off more than $10,000 in SALT each year, so they'll lose some of this deduction. This is going to hurt people in high tax areas like New York and California, said Lisa Green Lewis, CPA and expert for TurboTax in California. New Yorkers, for example, were taking SALT deductions around $22,000 a household. Rental property deduction, no change. The news is happier if you're a landlord. There continues to be no limits on the amount of mortgage debt interest or state and local taxes you can write off on rental property. And you can keep writing off operating expenses like depreciation, insurance, lawn care, and utilities on Schedule E. Home equity loans, big change. You can continue to write off the interest on a home equity or second mortgage loan if you itemize, but only if you use the proceeds to substantially better your home, and only if the total is combined with your first mortgage. Doesn't go over the $750,000 cap, 1 million loan for homes, or I'm sorry, loans in existence from December 15, 2017. Now, if you use the equity loan to pay medical expenses, take a cruise, or anything other than home improvements, that interest is no longer tax deductible. Here's a big FYI. The new rules don't grandfather in old home equity loans if the proceeds were used for something other than substantial home improvement. If you took one out 5 years ago to say pay your child's college tuition, you have to stop writing off that interest. 4 tips for navigating the new tax law. Number 1, single people may get more tax benefits from buying a house, Lydiard says. They can often reach and potentially exceed the standard deduction more quickly. You can check how much you're likely to owe or get back under the new law in the full article. There's a calculator. Number 2, student loan debt is deductible up to $2,500 if you're repaying, whether you itemize or not. Number 3, charitable deductions and some medical expenses remain itemizable. If you're generous or have had a big year for medical bills, these added to your mortgage interest may be enough to bump you over the standard deduction hump and into the write-off zone. If your mortgage is over the $750,000 cap, pay it down faster so you don't eat the interest. You can add a little to the principal each month or make a 13th payment each year. So this article was written by Leanne Potts. She's an Atlanta-based journalist and serial home remodeler. She's tackled 5 fixer-uppers and is working on a 6th. She's written about everything from forest fires to dog-friendly decor and spent a decade leading the digital staff of HGTV. So I hope you found value in that. You may notice that I'm wearing my Bears cap today. Now, it's my custom to wear it after a Bears victory. Unfortunately, the Bears didn't win yesterday. They lost. They lost during the wild card round of the 2018-2019 playoffs. Their kicker, Cody Parkey, had a double doink. In other words, the ball hit the upright and then it hit the crossbar, and then that was the end of the season. But, maybe next year. That is, after all, the Chicago rallying cry. If you're interested in Market Snapshot, and you should be, sign up now. The link you see on the screen is live in the show notes. Click that link, and you'll be on your way to getting information which will allow you to keep your finger on the pulse of real estate activity around your home or a home that you're interested in. So go ahead and sign up for that. If you have any questions about real estate, call me, Doug Perry, at 312-572-9801, or you can email me at dperry@propertyconsultants.com. I would love to speak with you, and I would love it even more if we can meet.